Hello, I'm Paul Archowski, and I'm here today with Michael Moskal, our Director of Investments, and Scott Lipa, our Senior Investment Analyst. We've prepared a short investment update to just kind of review what we currently see going on in the markets and the economy and share with you some of the questions we're hearing from our clients. And thought it'd be beneficial to get that out there to as many people as we can because we're hearing those questions from a lot of different people. So without further ado, I'm going to turn it over to Michael Moskal.
Thank you, Paul. Well, hi, everybody. What a difference a few months makes in the investment markets. We went from a very scary March and April to one of the biggest rallies that we've ever seen on Wall Street with the stock market recovering. Again, one of its biggest recoveries in history. So the question is, of course, where do we go from here? And today we're going to take a look at it and give you our opinion on where we think things are going. One of the most common questions we're getting from clients right now is, we don't get it. How can the stock market be hitting new highs or at least nearing new highs and looking great and the economy looking so bad? And it's a great question. And there's lots of people scratching their heads about it. Our take on it is, right now we're sort of looking at a battle that's raging on between the economy, which due to COVID-19 is in recession and is kind of pulling things down economically, certainly. And, usually in a recession, you'd see stock prices going down too in reaction to the recession. But you have something else going on, which is the Federal Reserve, which is our central bank here in this country, and the U.S. government, which are putting in, and I have stimulus in quotes here, because that's really just another name for money. They're putting in trillions of dollars into the economy and into the investment markets to try and make things look better. No doubt, COVID-19 has hit the economy hard. We've seen a record plunge, and you see the headline here. US GDP, which is just U.S. growth, plunges a record almost 33% in the second quarter. One thing, it's not 33% just in the second quarter. It's an annualized rate, and what that's saying is if things continue the way they are going, that's how it would look like after 12 months. We don't think that's going to happen, but regardless, it was a historical drop in economic activity, which I think everybody is not shocked about. We were shut down as a country economically, let alone the world just about, but certainly in our country, we were shut down for a while. So, things don't look great economically. Some people, of course, are feeling it economically there also. Still have a lot of people who are out of work. Right now, our unemployment rate is still over 10%, which you see on this chart is the highest it's been since going back into the 1940s. And that translates, by the way, into about 18 million people that don't have jobs right now. So there's still a lot of people out there looking for work. And again, it's still, is a big drag on the economy. However, that being said, stock and bond prices look pretty good. Stock market, again, has been on a historic rally. Why? What's going on? We mentioned the Federal Reserve. They're certainly a big part of why the market has been going up. What have they done? Well, they've printed about $3 trillion in money because they're allowed to do that. They're the only entity in this country that's allowed to just print money. And if you ever look back on the back of a dollar bill, it'll say Federal Reserve note. And that's the Fed printing money. So the Fed's printed about $3 trillion since March, and that's a lot of money, guys. So they printed a lot of money, and they bought financial assets with it. What are financial assets? Mostly bonds. There's a question whether they could buy stocks down the road to keep the market up, but we'll see what happens there. Why do they do that? Why are they buying financial assets? A couple of reasons. One is to drive interest rates down because the more bonds that they buy makes bond prices go up and it makes yields go down, makes rates go down. There's an inverse relationship. And why do they want rates low? For you and I to borrow money. We go to the bank, and if rates are low, we're going to borrow money and hopefully go out and spend things. And you got to remember that 70% of our economy in this country is you and I spending money. So the more we spend, the better it makes the economy work, and it makes the economy look better. So really the driving force between the Fed and the U.S. government is to try and get us to spend money.
So Michael, I think that's what clients that I've talked to are having trouble reconciling is you show the GDP number and how bad that is. You show unemployment and how high that is. And then at the same time, we say the Federal Reserve steps in, and that's what's that's what's stimulating the market. And people I've talked to are sort of waiting for the other shoe to drop as far as how could this disconnect be so great and the market continue to run the way it is. Well, something's got to give, right? And what I've been telling people is that we're in an era now of big banks and big government, and maybe it doesn't have to. The other shoe doesn't have to drop. Maybe we just go a long time, maybe a year, 2 years, 3 years, where we see very, very, very low growth because we've manufactured all this growth over the last few months relative to the proverbial other shoe dropping that people are afraid of.
Yeah, absolutely. We'll talk a little bit, Scott. There's chart in here about the disconnect going on and what may happen, but you're exactly right. This doesn't mean that it can't go on for a while like that. The second reason, by the way, they want to drive rates down, which is also item number 2 on here about cutting interest rates down. But the second thing they want to do is to boost investor confidence. And that's more the reason why you see that at least in the immediate short term, in the last few months here, that you've seen prices of stocks and bonds go up. It's investor confidence. And you guys remember back in the last financial crisis that we had, Ben Bernanke was the chairman, and that was his whole game that he had. He had something called what he thought was the virtuous cycle, which was going to be, if we can get stock prices up, people will get their statements in the mail at the end of the quarter. They'll see that their accounts are going up in value. They'll feel more confident, and they'll start buying things.
Yeah,
and
and I
so
think
again,
the difference between '09 and now, as far as what the Fed is doing, is it took the Federal Reserve 9 months to cut interest rates to zero back in '09. This year they did it. This time they did it within weeks. I mean, within a couple of weeks of March, all of a sudden we were right back at zero. Which my question is, do you think that interest rate is causing? I'm looking up and down my street right now, and I see houses for sale, and one directly across the street's for sale. Are we creating some sort of unintended housing bubble by leaving interest rates this low for as long as we have?
well, whether you want to call it a bubble or exuberance or something, right? Alan Greenspan years ago, Fed chairman, called it irrational exuberance. Yes, anytime you have the government step in and try to circumvent what's going to happen in the market cycle or business cycle, there's going to be some kind of consequence to it. It's just like a drug. If I don't feel good and I shoot myself up with drugs, there's going to be some consequence of it. It may make me feel good for a while, fine, and maybe it's necessary. Maybe I need to do it, but there's always a consequence from doing that. So if you want to kind of look at cutting interest rates to zero, the Fed printing all this money and buying assets, if you want to look at it like an economic drug, like a drug for the economy that's going to make it look good for a while, even though other things may not look good, yeah, sure, of course, it can make it look good. So we'll see. Of course, it looks like it. It looks like housing, because I have the same situation in my neighborhood. It's not very hard to sell houses around here, because rates are so cheap, money's cheap. It makes rates low for people to borrow and buy a bigger house and a house worth more money. Besides, it's the whole lower rates and people spend money thing. So yeah, absolutely. But we don't know what that's going to look like, right? So we got to see down the road. But we understand why the Fed's doing it. Part of their job is to try and get the economy going. It's sort of what their job is. If they did nothing, they would come under tremendous criticism. So I'm neither criticizing them or supporting them as much as saying it helps us, in our business, and helps clients that we're talking to right now. As your accounts go up in value as the Fed does these things. But sure, there's going to be some consequence down the road. The government's done the same thing. If you're looking at the federal government, and it's the same amount, actually, $3 trillion since March. We all know the CARES Act got passed, and that was really geared towards the average American out there. The PPP Act was really geared towards businesses, but if you add it up, it's $3 trillion that was put into this economic hole. One commentator kind of likened to the economy of sort of like a nuclear bomb going off, and you got this big hole that the government and the Fed is trying to fill in a short period of time. And we know Congress is debating and fighting over another stimulus package that could be worth $2 trillion. They're not fighting over whether they should do it. They're fighting over how much money they should borrow and do it with. So, of course, you can't just borrow ad infinitum and never pay it back. And we will have to pay it back down the road, and that's going to cause some pain. But I understand the motivation to try and make things look better right now.
understand the motivation. Then I think too is I've talked to clients about this as well. Is can we continue to punt the problem being coronavirus? Can we continue to punt it down the road to the with stimulus and with interest rates at zero to the extent that we sidestep it completely and come up with or have a vaccine by middle of next year or something like that. And if that happens, if that plays out where we just continue to punt the problem until such time as we have a solution, what does that mean for the markets? I mean, the markets could really take off from here if that scenario played out.
Yeah, absolutely. There's lots of scenarios. Before we did this video, we were just talking about Japan. And a couple of things. If you want to look at what economically could happen, just look at Japan the last 20 years, because we're doing the same things that they did. As far as cutting rates to zero, they're at negative, or they have been at negative. We could go negative rates. We won't address that here in this video. But rates at zero, printing all this money. Their government in Japan has printed lots of money and spent and borrowed lots of money, and it's not made their economy very good. They've grown at a very, very slow pace for many years. It's not guaranteed that's going to happen here that way, but you would think that all borrowing money here is borrowing future growth when you do that. So you would think you were just borrowing from future growth, that our future growth may not be that great. The premise, by the way, Scott, with the Fed and the government doing this is you hear a lot of them saying, well, we're trying to buy time until we can grow our way out of this. But, we would have to grow much faster than 2% GDP, which we've been growing at for how many years now?
Right.
15? We have to grow much faster than that to actually make up that ground. But, we'll see. We'll see what happens. But no, we can't just keep doing this. The government, even though it can print money, can't just do it ad infinitum again. It really has the same situation as we do as a household. I can borrow money and max my credit cards, and it makes me look great financially for a while, but eventually it's going to catch up to me. So it's just a matter of when it's going to catch up. We don't particularly think it's going to catch up anytime soon necessarily. The government can borrow money for long, long periods of time.
Michael, are you concerned? I'm sort of concerned about the idea of right now the stimulus and the extension of PPP. That all seems pretty easy from a standpoint of every elected official right now is very, very motivated by the idea of being reelected in November. So we can come to agreements on spending, and we're going to do that for the next few months. I get a little bit concerned after November, regardless of how the election goes, with elected officials' motivation to continue to print money and create or throw stimulus at this issue once they're all reelected or once everything is determined in November.
Yeah, that's a great point. And that gets to our, we'll do something on the election, at a later time, maybe closer to the election or maybe right after the election. Because those are all issues that we definitely want to talk about, because maybe it happens that way, maybe it doesn't. If you get a new president, or maybe the current president gets in, they don't just want to roll over and say, okay, I'm done. They have a certain responsibility and job. So we may see some of that abate. We may see some of it not. Maybe they just continue down this path and say, look, no one's resisting the fact that we're spending this money, and we're just going to keep doing it. So I don't know. It's just one of those things we got to kind of see what happens. And it does affect, of course, our clients' investments. And that's why we're talking about it. We talk offline a lot about it, because it does affect how the way we're going to manage clients' money. All that to say, all that money has done a very good thing for the investment markets. At least right now it has. And to getting back to the battle analogy, right now the Federal Reserve and the government's winning the battle against the economy when it comes to the stock market. You can see big gains. First quarter was scary. It was ugly. We were on here in April and it was scary. So we've had a tremendous rebound since then. I have second quarter plus July and August on here, and we're back to, in some cases even, some cases positive, some cases a little bit down with some of the stock market indexes that you see here. They're all a little different because we do get questions on this. But global Dow includes Dow plus foreign. Dow, of course, is 30 of the largest companies in this country. S&P 500, 500 of the largest. NYSE Composite may give a little bit more indicator what's going on in the stock market. That includes all stocks on the New York Stock Exchange. So that's all stocks. And then Russell 2000 is small caps. So, but looking way, way better than it did, of course, in the first quarter.
But I
You
think
know,
that it's a little bit misleading. I mean, obviously the numbers look dramatically better, but a little misleading if you take out the FANG stocks and you take out the work from home stocks. Call them work from home stocks, the Zooms of the world. If you take that small segment of the market out of these indices, I think the NYSE is probably a more realistic, broader view of what the market's doing relative to S&P or Nasdaq, where just a small the rally has been very narrow. It's just a small percentage of stocks that have carried everything relative to the broader market.
yeah, you could almost liken it, Scott, because it's a very good point. And I was talking to a client before we came on here, and I was likening this a little bit to the late '90s, because you had a very similar thing happening in that time period too. Different kind of stocks, except Microsoft was the same back then. But you had Cisco and MCI WorldCom, you had the dot coms back then, something similar. Um, but the fact is the markets have recovered. The fact is we are going up, but it is a concerning when you see a narrow leadership in the market. It's understandable, by the way, right? When you have the transportation industry, the hospitality industry kind of shut down in this country, you wouldn't expect their stocks to do very well.
Right.
So there are times when those stocks, energy stocks, led the market back in the mid part of the 2010s. So there's always a cycle that's happening. But yeah, of course, we'll watch that more closely. And it is a little concerning that you have a much narrower leadership as time is going on here. Bonds, same thing. Corporate bonds, certainly a negative first quarter, had to have a nice rebound as the Fed stepped in and started buying corporate bonds. High yields are still a little bit negative, but investment grade corporate bonds are positive. Government bonds have been very stable this whole year. It's been a place of stability. And, as much as people shy away from bonds because rates are low, again, during the down times, they look pretty good. Other investments, oil had a horrendous first quarter and then had a tremendous second quarter plus, still down 29% for the year. Gold's been steady all year, up 4%, 21, 26% for the year. Gold's been very good. That's an inflation play that we'll talk about just in a little bit here. All right, we'll continue on here.
Mm-hmm.
All right, Scott, this is what you talked about at the beginning, by the way. Something's got to give, right?
Right.
In this chart, you see the orange line or the brown line, whatever color that you see on your screen. That's the S&P 500 stock market. And then you see the blue line, which is S&P companies' sales growth. And then the purple line is GDP, U.S. economic growth. So there's a big disconnect going on there. Those lines over time want to converge on each other. They want to be closer to each other. So, either you got to have the stock market cooling down a bit, GDP having growth coming back significantly, or maybe it's a little bit of both over time. Maybe it's a little bit of both over time.
I'm with you, Mike. I'm of a mindset that orange line doesn't necessarily have to come down. I think that's what investors are afraid of right now, is that the S&P has to come back to previous levels. But I think in the era we're in now, with the Federal Reserve stepping in and doing what they do, and Congress stepping in and doing what they do, I don't think we as a society have the stomach for a 35% down year in the market. I think every entity would pull every lever it had available to it to avoid that. You can argue the long-term impact of that as positive or negative, but I think that's just the environment we're in right now.
Yeah, that gets back, by the way, to will the Fed buy stocks? And of course they're not allowed to buy stocks, but they can do it anyway. They weren't allowed to buy bonds.
If we saw the market down 20-25%, that wouldn't shock me in the least. Would be the Fed to come out and say, we're going to buy the S&P 500 index.
Well, Lael Brainerd, who's one of the Fed governors, she said that the last time this happened. She said, we're open to talking about it, so it would not be surprising to see it. Again, for good or bad, they would probably entertain something like that. What's ahead for the economy and markets? We're going to have an economic recovery. Remember that 33% number, the 32.9% number we saw earlier on as far as the economic decline. That was just an annualized figure based on if things continued the way that they were going. This is a chart from IMF, International Monetary Fund. They're probably more accurate for this year. Maybe we're down 6%, which is still a big number, by the way, down 6% in GDP with economic contraction. But, next year should look better. They're projecting out, nearly a 5% gain in economic growth for next year. Same with corporate earnings. This pink hole that you see here is a decline in earnings, and that's what's happened during COVID. So, we're going to have a bounce back at some time, as companies reopen, as everything reopens, but it may not be until 2022 till we see earnings coming back to where they were in 2019.
A lot of companies will come back. You figure a lot of industry. There's a lot of pent up demand created by all of this. What I get concerned about is the. I'd be curious as to if there's some sort of study as to what percentage of companies are surviving on PPP alone, and once that PPP money is no longer, corporate bankruptcies that we see, and I don't know what the number is. I don't know if it's going to be 5% of companies or 25% of companies. I guess it depends. That's one of those unknowns. I guess it depends how long this goes on and how much stimulus is put into the economy.
Yeah, remember, we haven't seen this in 100 years. So last time we had a pandemic was 100 years ago. So we don't really know what the outcome of this eventually is going to be. Headwinds, tailwinds, what could stop this market rally? COVID-19, if it drags on longer, if we have another flare up, if it gets worse, if we don't have a vaccine for 2 years, all those kind of things are unknown at this point that could put a drag on stocks over time. Valuations, again, how expensive stocks are, they're very expensive right now. Now, part of that's because you have an anomaly going on with corporations and earnings and what's going on with the economy. But right now, we're about 36 times trailing 12-month earnings. The historical average is 16. And again, that's a little bit skewed based on what happened this last couple of quarters. But we're still expensive in the market. That could affect it. If people just feel like stocks are expensive and they don't want to buy them anymore. What could push stocks higher? Scott, you've been talking about it. More support, more support, more support. More government stepping in and printing more money, putting more money into the system makes it look good. It does make it look good for a while. And low interest rates. We talked about that already. It pushes people out into risk assets because they don't want to sit in 0% earning or something like that investment.
Who wants a 10-year treasury paying 0.6%? I mean, you really have pushed. You penalized savers. You've pushed everyone into the market that wants any sort of return on their investment.
Yeah. Now the caveat to that is that when stocks are down 20%, 0.6 looks pretty good. At least it's positive. So, but when stocks are running hot like they are, low rates looks really bad, and it does tend to push people out into risk assets. All right, just shifting gears a little bit. We have one little chart on elections. People ask about how is the election going to affect the stock market, and we almost say, how's the stock market going to affect the election? It's the other way around, at least the way that we're looking at this little chart here, because there's an 89% prediction success rate based on how the stock market performs in September and October. So, and here's the background of it. Since 1900, 30 presidential elections. 17 of those 30 years, the stock market was up in September and October. And in 16 of those 17 gain years, the incumbent party stayed in power. So you're talking about 94% chance of the incumbent staying in power if the stock market's up in September and October. And then the flip side is, if the market's down in September and October, the presidency was lost in 11 of the 13 years that happened. So, again, pretty high percent. And that's why we're looking very strongly at September and October, how stocks do here, because there's a really big chance that it predicts on what's going to happen in the election. All right, what should you do as investors? What do you do? Again, if you're a younger investor or someone who's got a long time horizon, 20s, 30s, and 40s age-wise, you stick with your longer-term plan. But you do make sure you're diversified. You want to put all your money in Tesla, all your money in Apple, all your money in Amazon. Like some of my nephews, you want to make sure you do diversify into different areas. Some bigger companies, smaller companies, mid-sized companies. Having bonds is okay for risk control. Again, when the market's down, bonds look better. So it's okay to have some position in bonds, even though they don't pay a lot. Going back to this rule's been around for, I don't know, way past since I've been in business, and I've been doing this for 30 years. And I remember reading about this actually in college, which is longer than that. So take 100, subtract your age, and that's a percentage of stock allocation. And that's not something I'm telling people to do. I'm just saying if people aren't sure and they really don't know, that may be just sort of a general guideline to look at to see where you're at. And then what we've been talking about with all the printing of money, somewhere down the road, inflation is going to rear its ugly head. It hasn't yet, but we look at it and say it's going to happen somewhere down the road. And when that happens, you want to make sure you have something allocated to inflation hedges like commodities, agriculture, precious metals, something like that. And then older investors, shorter time horizon, people in their 50s or older, same thing, stick with your longer term plan, but maybe a little bit more balanced, making sure you're not over risked with what you're doing. A little bit more on large cap dividend payers, the stocks like the Kraft Foods of the world, Procter and Gamble's, utilities, banks, the financial industry that pay dividends. Those are not bad places to be for dividends. Bonds, want to keep higher quality bonds. And then same thing with inflation hedges, maybe even having a little bit more there with inflation hedge with older investors.
Yeah, when I'm talking to clients, Michael, I always mention there's only two ways to make money in the stock market. That's share prices going up or companies paying dividends. And if we're of the mindset that the S&P doesn't have to fall 20, 25, 30% to match or mirror what's going on in the economy, what's a more likely scenario is low and slow growth. And in an environment like that, a dividend is your payment to wait out that market.
Mm-hmm. Exactly. That's exactly right. Exactly right. All right. Is anything else you guys have? That's really our report at this time. And we'll do this again, closer again to the election, with a little more focus maybe on the election and what's happening at that time and the effect it's going to have on the markets. But again, I think the bottom line of all this is, there is a reason why it looks like it does right now with stocks up and the economy down. There's reasons why it looks that way, and it is helping us in the short term right now, which is good for us for now.
And we want to thank you for joining us, and watch for more of these videos in the future, and stay safe, stay healthy, and we'll hope to see you again soon.
Take care.
Take care. Bye-bye.